Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. Over the last few weeks I've been traveling quite a bit, and all the videos that I've basically shared with you guys were recorded in random places, hotels and so all sorts of places. So Alhamdulillah, I'm back at home, and yeah, I've got loads of plans inshallah moving forward that I want to share with the community. Loads of videos that I planned over the last few weeks as well while I was on holiday. So inshallah I'll share with everything with you guys. As always, I'm going to stay transparent. I'm going to try to do everything I can to share my journey with you guys, because remember, that's the whole reason why we're here. That's the reason why you're here right now. You're watching these videos because you are interested in Sharia compliant, number one, and number two, you're interested to see what other people are doing, so you can actually do your own research and then learn more about stock market, the stock market itself, and individual stocks and ETFs and so on. And thank you for tuning in week in, week out. There's so many of you that basically message me and join us the Patreon account and been very complimentary, is that the word, about everything we're doing here, and I genuinely appreciate that. And yeah, so let's get started. And what I want to do today is talk about 7 companies that are really, they feel right now basically very, very cheap. And I'll give you the valuations of these companies based on the valuation that we normally use, which is a Morningstar. They are all undervalued at this point in time. Every single one of these companies, in my opinion, is a high quality business. And right now, all of them have a wide moat. And as we know, that's important because that means the company is basically one of the best in that industry, if you like. And they have, they've got things that the competition doesn't offer, if you like. And if you look at the S&P 500, year to date, we are up 8% when it comes to the S&P 500, 3% or 4% when it comes to Dow Jones Industrial. Nasdaq is about 12%, and FTSE 100 is about 10%. What I'm going to do with the FTSE is, inshallah, I'm going to look at the best performing stocks within the FTSE 100, and I'm going to share that with you guys because I think it's like the one I'm talking about, Sharia compliant ones, because we want to see what is basically driving this overall market, because right now it's beating the S&P 500, which is really good. I mean, I haven't seen that for so long. So yeah, let's get started. I'm going to share with you these 7 companies. Do your own research, of course, as always. And if you haven't joined us at the Patreon account, please do so. You get access to a lot of things, including basically the family portfolio, the subscriber portfolio reviews. I have been flying around basically for the last couple of days, so I haven't had the chance to actually check the email. But I'm going to do that today, inshallah. And then I will basically, if I have not replied to you, apologies, I will be replying today, inshallah. Right, let's get started. As always, we're looking for basically the similar sort of information. The one thing I've highlighted here in yellow is the moat. Every single one of these companies has a white moat, which means basically they have a, basically something that their competition doesn't offer. Everything else is more or less the same. And like I said, all of these companies are undervalued at this point in time. And the first one we're going to look at CRM. CRM is one of the companies that I own in the portfolio, both portfolios, the family and as well as the passive income portfolio. And as you can see here, it's about 35% undervalued at this point in time. And look at the growth side of things. So the expected revenue, this is for 2026. So EPS growth expected to be 12% and revenue about 9%, which is really good. 35% upside from where we are, which is really good. But I think this is probably the cheapest it's been for quite some time, $240 per share. It's been hovering around that, and it hasn't reported yet. I think they report, let me just quickly check. They will be reporting in, when do they report? Oh, September the 3rd. So let's see what they report by September the 3rd. And as you can see, a lot of basic revisions basically moving up rather than down, which is quite nice to see. And if you look at the in terms of expectation moving forward for this company, basically this is what they're expecting every single year. Now, if we look at fast graph, for example, and you use the normal estimate, the stock seems a little bit expensive right now. So you'll be losing about 10% of your money. But if you use the normal multiple, okay, which basically is that 40p, and I don't think this company is a 40p, even if it's like right now I think it has a forward PE of like 21, 22, I think it was, there we go, 21. So even if you hit that rather than that 21, so if we go back to estimates and we are looking at not 15 PE, we're looking at about 21, okay, you will still be making about 27% of your money, basically on top of your money, basically. So $12,717 is what you will have, and that earnings expectation is of 12, basically over 12%. It's just really good, okay. I normally, you know, I've always said to you guys, just basically add another 10% for you for margin of safety, which is good. But based on this, I think this is absolute buy right now, and that's exactly what I'm doing. You might be surprised to see basically Eli Lilly on this list, but look at it. Based on, okay, Morningstar valuation is 4%. It has a 4% upside from where we are. $650 per share is where they think is the price should be. Last week it came down a lot. There are a few reasons. I'm going to talk about it in another video. I've got a plan. I don't know which video will be released first, but yeah, there's another video that I will be releasing that where I will be talking about this company. But it's a great company. Again, look at this expectation: 34%, okay, growth estimate for next year, and 19% when it comes to revenue. That's absolutely huge. And if we go on here, let me show you this company, okay. If we just look at the earnings expectations moving forward, it's ridiculous. So this year they're expecting 73, 24%, 34%, 23%, 14%. And there's a lot of analysts looking at this because of the GLP-1 thing. Basically, this is probably one of the reasons. And look at the revenue growth as well, expected from 60 billion to like 90 something billion to almost 100 billion in about 3 years. So it is huge growth expected. Basically, it's expected to grow massively. But let's now have a look at the fast graph and check this out. Estimates, based on the current estimate, you will double your money if you bought the stock today, which is absolutely crazy. Okay, so 100%. Basically 103%, so $20,373 is what you would have by the end of 2027. 2.5, basically 2 years and a bit. Okay, you will double your money if that basically happens. If we look at these based on these estimates that we're looking at now. If we look at the normal multiple for this company is what's been trading, which is 40. Basically, you will have 24,000, another 4,000 on top of that because of this massive growth that we're expecting from this company. So let's see how it goes anyway. But that is another high quality business that is currently trading and basically currently undervalued, if you like. Next one is the similar situation. This one is also another company in a similar sort of industry. These two are competing right now. Eli Lilly is taking a bit of a market share from this one when it comes to the obesity and the diabetes, basically drugs and so on. It has taken quite a bit of the market share, and this one is struggling a little bit. They forecasted it slightly lower. It's gone down a lot. So it will be interesting to see how the companies go. But look at this one as well. They expected double-digit growth next year. And let me actually have a look at if they have changed any of this over the last few weeks, because this is like an ongoing thing. So the next year they're expecting 2026, they're expecting about 3%. So that has now actually changed. So we're going to update this information because that's no longer, because if you think about it, let me see the revenue. Okay, so this is more or less the same as what it was, okay, but they're expecting the earnings to decline, which is fine because that's normally like this one are normally where I normally get my information from, and you might not be able to see because I pay for subscription, which is one of the reasons why I always ask you guys if you can join the Patreon account. It definitely pays for a lot of these things, so if you can join us, that would be absolutely amazing. So yeah, there you have it. That's 3%, next year 12%, but this year basically expecting massive growth. Again, there's not a lot of analysts looking at it and in comparison to Eli Lilly. But yeah, so let's have a look at now Novo and see where they think the price should be. So if you use a normal multiple where we are right now, you'll be making $14,487 based on on the top of your initial investment. So you invest 10,000 and you'll be making another $4,487 US. That's based on the normal estimate. If you use the estimates, but if you use the normal estimate, which is basically what Mr. Market likes to trade this company for the last whatever years, look at that. That 40 or 30 PE, if you like, you will have about $28,753 on top of the basically what you've initially invested in, in addition to basically. So it is another one that's really undervalued. This one was down I think almost to 20 something percent. Let me go on FT and T. I think it was down 20 something percent on the day they have actually reported. There we go, 24% basically just for that last week, and 30% for the 1 month. A year to date is about 21% down. It has a forward PE of about 30, which is a bit of expensive for this company. But when you look at the earnings expectations moving forward, it's decent. So 2026, that 11%, 13%, 2%, 4%. And then when it comes to revenue, double digits as well. So right now, 45% upside from where we are. The price is $74 per share, and I do own this one in the family portfolio. Again, is another one that I own. So I'm not trying to sell you companies that I own, but it is important to let you guys know what is basically going on with these companies. But if you bought it right now based on that 15 PE, which I think this is basically is not great for this company, is you will be losing about almost $4,000 of your money. But if you use the normal multiple, which is basically what Mr. Market has to like to trade this company, which is at 42, you'll be making about 7,000, almost 8,000 on top of your money. Now, if we look at basically, let's say basically this company is more, what is the forward PE? We said 29, wasn't it? Let's go back. I think it was 29, almost to 30. If we use that basically as a base, let's say that 29, 30, you'll still be making 25% or 10% every single year for the next couple of years on top of your money, which is really nice. So it still feels undervalued if you like. The next one is Now, which is basically ServiceNow. Again, very similar to Salesforce, another company, $872 per share. If you look at this, 20% upside from where we are. Expected earnings about 19%, revenue about 19%, which is really nice. If we look at the fast graph, for example, check this one out. Let's see what fast graph thinks of this one. Very expensive if you use that 15 or 19 PE, okay, which is basically the fair value for this stock. But if we use the normal multiple, which is where it has been trading over the last 5 years, then we will be making about 23%, 132% on top of basically what you initially had, which is absolutely massive. But I don't think that's the case for this company. Even if we say 50, even if you say 42 PE, let's go back here and just see where this company is with regards to forward PE, and then maybe that'll give us an idea. Okay, so 50ish. Okay, so if we look at the 50 PE, okay, as you can see there, basically we'll be making about 14-15% total annualized rate of return, which is really nice on top of your initial money. Right, the next one is ASML. This one we talk about every single week and is still undervalued, 32% upside from where we are. And as you can see here, they expected the earnings and everything to, let me see if they have actually massively changed over the last couple of days, because I planned the video a couple of days ago. Things are changing quite fast. By the way, look at that. It's all buys. Even Quant is saying it's a buy right now. Earnings expectations moving forward, that we knew this one, 7%. What did I say here? That 7%. So nothing has changed, I think. And then about 4% for the revenue side of things. Yeah, nothing has changed. And I think, but when you look at that double-digit growth expected for the next couple of years, that's what we basically, the reason I think this is still undervalued. ASML is then, let's have a look. So expensive still if you look at that one, but if you use a normal multiple moving forward, you'll be making basically another 10,000 on the top of the 10,000 you've already made. If we look at the forward PE for this one, just to kind of give us an idea what the analyst is, 25 PE. So if we use that 25 PE, okay, or even 24 PE, you'll still be making about 8.5% on the top of your money, which is quite nice. The final one is Canadian National Railway, and 57 when it comes to your market cap. It has a wide moat as well. All of these companies have a massive moat if you think about this. $92 per share right now. Dividend yield almost 3%, which is nice. The payout ratio is very, very low. They have increased the dividend for 28 years. They're not in the part of the S&P 500, so they cannot be dividend aristocrats. Now, in terms of moving forward, you get 10%. EPS 5% when it comes to revenue side of things, 13% upside from where we are. Let's now have a look at this company in here. CNI is the ticker symbol. CNI. Let's see what this says. Okay, if you bought this stock right now where it is, you will be making about 16% or almost a 7% total annualized rate of return on the top of your money, which is really good. And then if you use the normal multiple, that not by the way multiple was about 15, which is good. And if we use this one as well, 22, you'll be making about 25% or almost 28% total rate annualized rate of return, which is really good. That 10% is actually really good for this type of business. So there you have it. All of them are really high quality businesses in my opinion. I promise you I would actually buy every single one of them. In fact, I do own 1, 2, 3, 4 out of the 7 in here. Okay, and a couple of them are on my watch list. So yeah, basically as you can see, these companies are very high quality businesses. They have a wide moat. All of them seem basically undervalued at this point in time. What I will definitely do if I were in your shoes is just to give yourself little bit of margin of safety. So for example, Eli Lilly may be very volatile stock, or CRIM, or whichever you think is basically whatever, then give yourself 5%, 10%, 15% depending on what you think. So for example, Canadian National Railway, for example, I would give myself about basically 5% because I don't think it is very volatile stock. I think they can easily meet this sort of expectations, whereas Eli Lilly is basically, if something happens, because it's a high growth company, they don't actually do as well as they expected. The EPS basically is revised and is slightly goes down, or the company comes out, says exactly what this company has said, then anything can change. So for that reason, I'll give myself about maybe 5%, 10%, and so on. So anyway, that's what I wanted to share with you guys today. The final thing is this. Okay, you can pause the video and have a look at this. As always, if you join us at the Patreon account, that will be absolutely helpful to the channel. Of course, let me know if you have any questions. I will be sharing another video in the basically next couple of days, inshallah. And let me know if there's any companies that you think that are undervalued at this point in time that you would like me to look at, inshallah, before I go back to work. I think I'll go back to work about a week. So I've got 1 more week, inshallah, where I can actually do a lot more videos for you guys, inshallah. From there onwards, we can just go back to the usual, a video a week, 2 a week, and so on. But for now, as well, I still have time, I'm going to try to do as much as I can, inshallah. Anyway, have a wonderful day. Assalamu Alaikum.